South Africa's tax system is increasingly being carried by older, better paid workers. And this is raising concerns about the long-term sustainability of state finances. New figures from SARS show taxpayers aged 55 and older now contribute more than a quarter of all personal income tax on taxable income of nearly 700 billion rands. By contrast, younger South Africans, who make up more than half of the working age population, contribute a far smaller share, reflecting persistently high youth unemployment and low earnings. Economists have warned that this creates a structural risk for the fiscus, as experienced higher earning workers retire faster than younger taxpayers can replace them. The data adds urgency to calls for faster economic reform, job creation, and a broader, more resilient tax base. Pan-African Resources has reported a strong operational performance for the first half of its 2026 financial year, underpinned by a sharp rise in gold production and a significantly stronger balance sheet. Gold output jumped 51%, and further production gains are expected in the second half, putting the group on track to meet its full-year production guidance. Now, during the period, the company has also substantially reduced net debt. That's down more than 65%. Against this backdrop, Pan-African has proposed the initiation of an interim dividend of 12 cents a share. This will be considered by the board when the firm releases interim results next month. Cashbuild has delivered modest revenue growth in the second quarter of its 2026 financial year. That's as new stores helped offset pressure at existing outlets. Group revenue rose by 1% year-on-year, with sales at existing stores down 2%, while new stores contributed 3% growth. For the half-year, revenue is up 3% compared with the prior period, and that's thanks to higher transaction volumes and limited selling inflation of just under 1%. Spear has delivered a solid 10-month performance and has revised its full-year guidance higher. The Western Cape-focused REIT's distributable income per share rose nearly 6% year-on-year during the period, while revenue increased by more than 20%, supported by stronger letting activity, improving occupancy and growth in solar income. The group's balance sheet remains sound, with loan-to-value at around 25% and interest cover comfortably above covenant levels. Portfolio occupancy has improved to just over 97%, the highest level since the onset of the pandemic, driven by sustained demand across industrial, retail and commercial assets in the Western Cape. Off the back of the stronger trading performance and easing interest rates, Spear has upgraded its full-year distributable income growth guidance to between 5 and 6%, while maintaining a payout ratio of 95%.